Ever wonder how the rich seem to make millions and still pay less in taxes than you? Here's the truth. They're not breaking the law. They're using the law better than anyone else. In this video, we're breaking down how the wealthy legally avoid paying high taxes in 2025. These aren't loopholes just for millionaires. Many of these strategies can be used by almost anyone, if you know how. Let's start with one of the most powerful. 1. They own businesses, not just jobs. When you work a regular job, your taxes come out before you ever see your money. But when you own a business, it's the other way around. You get paid, you spend money on your business, and then you pay taxes on what's left. This means the rich can deduct things like travel, equipment, subscriptions, even part of their home, all legally as long as it relates to their business. Starting a simple side hustle, or LLC, can open this door. You don't need to run a huge company to access business write-offs. You just need to treat what you do seriously. 2. They use real estate to create phantom losses. Here's something wild. Many wealthy people make money on their real estate, but claim a loss on paper. This happens through depreciation, a tax rule that lets you deduct a portion of your property's value every year, even if the property is going up in price. So you could have a rental bringing in cash every month, but on paper, your taxes show a loss. That loss can be used to offset other income, like salary or capital gains. It's one of the most powerful tax tools in America, and real estate investors use it constantly. 3. They borrow instead of sell. The rich don't sell their assets. They borrow against them. Why? Because loans aren't taxed. Let's say a millionaire owns a stock portfolio worth $5 million. Instead of selling it and triggering capital gains taxes, they take out a low-interest loan using that portfolio as collateral. They get the cash and pay nothing in taxes. This is known as the buy, borrow, die strategy. It sounds shady, but it's 100% legal and often used by the ultra-wealthy to live tax-free while their assets grow untouched. 4. They max out tax-advantaged accounts. Then some. You've probably heard of IRAs and 401ks. But wealthy individuals fully exploit these tools. They use Roth IRAs, solo 401ks, SEP IRAs, and even backdoor Roth contributions, all to legally grow wealth tax-free or tax-deferred. For example, a solo 401k can allow self-employed people to contribute over $66,000 per year as of 2025. That's a massive deduction, especially when your income is high. The wealthy also use health savings accounts, HSAs, as triple tax advantage tools, one of the most overlooked legal shelters in the tax code. 5. They hire their kids. Yes, really. If you own a business, you can legally pay your children a salary for helping out and deduct it as a business expense. As long as the work is legitimate and the pay is reasonable, this reduces your taxable income and gives your kids earned income they can invest in things like Roth IRAs. It's a win-win tax move that keeps money in the family while cutting taxes. 6. They plan with trusts and estate strategies. At the highest levels, wealthy families use trusts to move money between generations with minimal tax exposure. This includes grantor trusts, irrevocable trusts, charitable remainder trusts, and more. They're complicated, but legal, and they allow massive fortunes to pass on without triggering huge estate taxes. If you're just getting started, these may sound out of reach, but learning about them early puts you ahead of 99% of the population. Let's quickly recap the top strategies. Own a business to control when and how you're taxed. Use real estate depreciation to claim paper losses. Borrow instead of sell. Loans aren't taxed. Max out. Tax-advantaged accounts. Solo 401k, HSA, etc. Hire your kids and keep money in the family. Use trusts to protect and pass on wealth. None of these strategies are secret. They're public, legal, and widely used. But most people don't take the time to understand them. Or worse, they assume they're only for the ultra-rich. That's why channels like Penny to Portfolio exist, to break down complex wealth-building tools into actionable steps anyone can start using. If you learn something valuable, subscribe and turn on notifications. And comment below. Which of these surprised you the most? Thanks for watching. And remember, your portfolio starts with your first penny. But keeping more of it starts with tax strategy.